Hello. The purpose of this presentation is to give you a basic understanding of loan repayment and steps you can take to make sure you do not fall behind. This is not a substitute for the mandatory exit counseling. Exit counseling is tailored to you personally and is much more detailed and in-depth than this overview presentation. While you are in school for at least 6 credits, your federal loans can be in deferment, meaning no payment is required, but interest may be accruing. But now that you're leaving school, you have to be prepared for the next steps. Once you graduate, leave school, or drop below 6 credits, your federal loans go into a grace period. This is the time for you to figure out your finances and be prepared to make payments once the grace period ends. For the subsidized and unsubsidized loans, the government gives you 6 months of grace. For the Perkins loan, students are given 9 months of grace. Graduate Plus loans don't have grace, but rather an automatic deferment of 6 months. This affects interest capitalization, which will be discussed later on. How interest accrues during grace depends on when you took out your loans and what type of loans they are. If you are serving active duty, your loans will be in grace for the duration of your active duty. If you are called to active military duty for more than 30 days before the end of your grace period, you will receive the full 6-month grace period when you return from active duty. If you consolidate your loans, the timing of your application could affect your grace. If any loan you want to consolidate is still in the grace period, you can delay entering repayment on your new direct consolidation loan until closer to your grace period end date. You will indicate this when you apply, and the consolidation servicer will wait to process your application until the appropriate time. If you fail to indicate this on your application, once it is processed, you will enter repayment. We will discuss more about loan consolidation further in this presentation. If you return to school, your loans can go back into deferment. It is important to note that if you leave school, use up your grace period, and then go back to school, you will not have additional grace period months given to you when you graduate. But if you use less than the 6 months of grace, the clock does reset. We at Stony Brook notify students of their exit counseling requirement via email and solar to-do list. Exit counseling is required when you graduate, leave school, or drop below half-time enrollment. Exit counseling provides important information to prepare you to repay your federal student loans. At the end, you'll need to provide the name, address, email address, and telephone number for your closest living relative, 2 relatives who live in the U.S., and current or expected employer. So you may want to have this information available before you start. It is vital that you know what types of loans you've borrowed and what the amounts are. Next, we're going to talk about the loan types and how you go about finding them. There are 2 types of loans, federal and private. In addition, there are multiple types of federal loans a student can receive. The subsidized loan is only available to undergraduate students, and while the interest on the loan did not accrue while in school, in general, it does not accrue during grace period. However, if you borrowed a subsidized loan between July 1st, 2012 and July 1st, 2014, be aware that interest will accrue during your grace period. Unlike the subsidized loan, the unsubsidized loan was accruing interest while you were in school and during grace. This means you may owe more on the loan than what you originally borrowed. If you borrowed a Perkins loan at Stony Brook, you will receive an additional notification to complete Perkins exit counseling. For Graduate Plus, this loan is only available to graduate students. If you're an undergraduate student whose parent borrowed a Plus loan, it's under their name, not yours. Your private loan and your federal loans are treated very separately and each have their own terms and conditions. Now that we've reviewed the loan types, it is important to understand how to go about finding your loans. All your federal loans can be found on NSLDS. NSLDS is a federal database that keeps track of all your loans, no matter what school they were borrowed at. To log on to NSLDS, use your FSA ID and password. This page will also show you who your loan servicer is, who you will be making your payments to. If you have taken a private loan at Stony Brook, you can go check your awards by year in Solar. Once you find the year you took out the loan, feel free to contact the financial aid office and we can help you figure out who you borrowed loans from. If you have attended other schools, you can pull a free credit report on yourself to find your lenders. If you have never seen your credit report, this is a great resource, regardless of your lending history. The federal government works with loan servicers to help maintain all the thousands of loans that students across the country have borrowed. It is very important that you know who your servicer is and that you set up an online account on their website to easily manage your loans. Your servicer works with you on all repayment issues. If you have any problems with repayment, you should contact your servicer as they are there to help you. To start, your loans will be with one of the four servicers on the left. At some point during repayment, your loans could be transferred to a different servicer. This should not disrupt your loan management. You will be notified in advance before any transfer occurs. For a list of current loan servicers, you can check studentaid.ed.gov. Earlier in the presentation, we talked about loans that accrue interest. Interest capitalization is the addition of unpaid accrued interest to the principal balance of a loan. For example, you borrowed a $5,000 unsubsidized loan. While you were in school and during your grace period, you did not make any interest payments and you now have $1,000 in unpaid interest. When the interest is capitalized, your new balance is $6,000. And while you're in repayment, interest is accruing on the new balance. Therefore, you end up paying interest on interest. Because of this, you are highly encouraged to make payments on the interest while in school and during your grace period if possible. Now we will provide an overview of some of the repayment plans available. If you do not select a repayment plan, then you are automatically considered in the standard repayment plan. Under the standard plan, your total loans are evenly divided into 120 equal payments as you are given 10 years to pay off the loan. Under this plan, you will have the lowest interest accrual and the loan will be paid off in the shortest period of time. However, under this plan, the payments may be higher than you can realistically pay. If you owe more than $30,000 and the standard plan payments are not feasible for you, and you may want to extend your payments, talk to your loan servicers about an extended repayment plan. Under this plan, your monthly payment will be less than it would in the standard payment plan, but you will be paying significantly more interest over the life of your loan. There are two different graduated repayment plans. These are an option for borrowers that have a current low income but believe they will be making more money down the road. Every 2 years, your payments will go up until your loan is paid off. The chart in this slide illustrates what your monthly and total payments would be under the four repayment plans, assuming you borrowed $31,000 at an interest rate of 6.8%. Take note of total interest payments and total loan payments under the different types of plans. The reduction in the monthly payment amount may not be worth the extra interest paid over the life of the loan. You will be able to see a comparison of the payment plans with your loan information when you complete exit counseling. There are a number of income-driven repayment plans available that tie your monthly payment amount to your annual income. Eligibility for the plans depends on the amount you borrowed, the types you borrowed, and your annual income. Detailed information about the plans, along with the repayment estimator, is available on studentaid.ed.gov. There is a lot to consider with the repayment plans, so speak to your loan servicer if you are unsure on which one is right for you. In most cases, you can switch between plans if you are having difficulties or unsatisfied with the one you selected. Loan consolidation takes all of your little loans and turns it into one big loan. You need to consider the pros and cons of consolidation. This is helpful if you have to make many payments to multiple servicers. However, in most cases, your federal loans will be with a single servicer. In the past, federal loans could only be consolidated through a direct consolidation loan. However, you now have the option to consolidate federal and private loans through a private lender. Understand that this route turns your federal loan into a private loan, and you will forfeit potential benefits and repayment options. Once loans are consolidated, it cannot be undone, which is why it is so important to consider all aspects and whether or not this is right for you. Forgiveness, cancellation, and discharge of your federal loans happens under certain circumstances. There are various options available depending on your career path. For example, if you are working for a nonprofit, you may want to explore public service loan forgiveness. For additional information about these programs, refer to your loan servicer and material available to you on their websites. With the Get on Your Feet Loan Forgiveness Program, New York State will pay for up to 24 months of your federal student loan payments to recent New York State college graduates who are participating in a federal income-driven repayment plan. For detailed eligibility and program information, visit www.hesc.newyork.gov. Default occurs if you fail to make payments on your student loan. Defaulting on your student loans has serious consequences, and by being knowledgeable of your options and planning ahead, there's no reason you should default on your student loans. If you are having a problem meeting your monthly payment obligation, contact your servicer. Switching your repayment plan may provide a more manageable monthly payment. There may come a time when you feel you truly cannot make payments. You should contact your servicer to discuss the options of either forbearance or hardship deferment. These should only be used as a last resort option. There are a number of consequences should you default on your student loans. If you don't pay your loans, it can result in credit report damage for up to 7 years, collection costs, which can add a significant amount of what is owed, loan balance due in full, meaning you lose your time to pay. You can lose a state occupational license if you have one. You can experience wage garnishment, seizure of tax refunds, legal action in federal district court, and finally, they can determine that you're Title IV ineligible, meaning that if you return to school, you'll be unable to use federal aid programs for assistance. Again, you can avoid repayment problems by planning in advance. Establishing a budget system for yourself can help you meet all your financial obligations, including your student loan payment. Some budget methods available for you include the following. Pen and paper. This method can be useful for simple budgets, though it may not be as convenient for expense tracking. Phone apps. This method is very convenient and offers many free options, however, it may not be robust enough for some. Software. There are a number of software programs you can install on your computer that can be useful for students. If you already have Excel, there are a number of templates that may be helpful. Online. There are many web-based budgeting tools that can be used. For example, Mint.com will email you when a payment is due. You should also keep in mind that many web-based budgeting tools will also sync to smartphone apps. In addition, certain banks may also offer online tools that you can utilize. If you have no experience using a budget, it comes down to 4 basic steps. Identify a time frame. In determining a time frame for your budget, most people set it up monthly because that's how most of your bills come through. Next, you want to identify your income and look at how frequently you get paid. It is important to know that when you get a job offer, the amount you will actually take home each week or bi-weekly will differ than your annual salary due to taxes and other payments. This is an example of net pay based on different salary levels. Next, you should identify your expenses and bills you have to pay. Finally, at the end of the month, you should review how you did and make any adjustments for the next month. While using a budget may seem a little tricky at first, you may be surprised how helpful it can be once you get the hang of it. Again, you must complete exit counseling, which you can get to by clicking on the link in this slide. Thank you for watching, and I hope that this has helped you gain a better understanding of loan repayment.